Hey everybody, welcome back to the Market Interest, where we talk stocks, finance, and the investment markets. As you know, I'm always on the hunt for stocks with substantial growth opportunities, but the Feds aren't making it easy for anybody right now. Inflation is through the roof, interest rates are going up, tech stocks are just getting smashed right now, and people are getting crushed wondering what to invest in next. Well, I've been eyeing one stock that really pops out to me as a great defensive position, a company that is actually making money. What a shocker. So many of the high-growth tech stocks with zero profits are collapsing right now, while cash-producing stocks, especially ones that pay a dividend, are gaining momentum. And I'm talking about companies like Coca-Cola. Now, I know it doesn't seem all that exciting of a company to invest in, but let me tell you, their finances are actually pretty interesting. And with all the craziness in the markets, investing in companies that keep their value and increase their dividend is quite attractive at this point in time. If you want to stay on top of cutting-edge investment ideas, hit the subscribe button so you don't miss out on any of these popping opportunities. And if you get any value out of this video, go long on the like button. Coca-Cola Company is a cash cow, so much so that Warren Buffett, the god of value investing, is piled high in this company, making it his fourth largest holding in the company Berkshire Hathaway's B shares. So I was excited when an old friend asked me to do a review on Coca-Cola stock. As you know, Coca-Cola is a beverage company, but you probably didn't know the amount of products that it actually offers. It has 200 different brands that it owns and markets, such as soft drinks, water, sports drinks, teas, coffees, juice, energy drinks, and more. The company operates internationally, which I'm sure you all know, with its products available in more than 200 countries and territories. That's impressive. With a diversified product line and broad market base, it's hard to imagine the company could be rattled through some temporary market shifts. But an argument can be made against the company due to their decreasing revenue that we've seen year after year, which is really quite a shock. So let's dive a little bit deeper into the numbers. So when I first pulled up Coca-Cola and started looking at their revenue, what really shocked me was I have a conditional formatting for the past 10 years. And I thought there was a mistake with the data, but going back, looking up here, you can see that their best years were behind them in terms of their revenue. So they were making more money back in 2011, 2012, 2013, 2014 than they were today. So it was quite shocking, and I thought there was something wrong with the data and figured, let me jump to another resource. Went over to Seeking Alpha just to confirm that what I saw is actually right. Their revenue has been decreasing year over year. But yeah, it was a bit shocking. And that usually raises a red flag because a company that is consistently losing revenue or not getting as much revenue as previous years, they can't stay in business for very long. They generally can't stay in business forever if they're losing revenue. So the next logical thing would be to check out their margins, their gross margins. And when I took a peek at that, I was very happy with what I saw. As you can see here, they've had gross margins of about 62%, and that's been steady for 10 years. It's been steady for a decade. So people who are running, who are managing their cost of revenue, cost of goods sold, are doing a really good job at controlling that and keeping their gross margins stable, which is really important. And same with their operating margins, as you can see here. They've been pretty stable as well, which if you guys know me, that's a huge factor, is making sure that their operations are being controlled properly. And because they're doing such an excellent job at controlling their operations, that carries down to the bottom line. And what's the bottom line here? This is what blew me away. Their net margin is actually increasing over time. And think about that. That's like you getting paid less to go to work. All right, you're getting less revenue coming in, but because of the way that you're managing your household expenses or your operations, the way you're investing, you're still able to keep more money, a higher margin in the bank after all those expenses. So I applaud Coca-Cola for the way that they are managing their business. Their operations are on point and really just phenomenal. It's not something that you can say about a lot of companies in terms of their operations. Usually when a company starts losing more revenue, that carries down to the bottom line, or it can carry down to the bottom line, which means that they're not making as much of a profit. Clearly, as we're seeing here, their revenue has been decreasing over the last, let's say, 10 years, but their net income margin, their net margins are increasing over time, which is a really positive thing to see from such a large company. And that really shows the importance of managing operations appropriately. If companies are able to increase their efficiency, they'll generate more value for their shareholders. What's exciting about this company is their margins aren't the only things that are increasing. If we check over here onto Seeking Alpha, their dividends have been increasing every single year as well. And if we check this out, over the last 59 years, they have increased their dividend every single year, consecutively, 59 years. The sector median is only 3 years. So that's just wild. That blows me away. Coca-Cola is also one of the only companies in history that has paid a dividend for over 100 years consecutively. So that's really, really impressive from a company. It just shows the stability, how the management is approaching their financials to be able to consecutively increase their dividend and also provide income for their investors. This is really bringing value to those investors that are seeking income. And it's not just for investors that are seeking only income. If you're the type of investor that wants consistent dividends and to reinvest those, there's a site here where it can show the value of what your account would have been if you started investing in Coke. Let's say you threw $1,000 in there in January of 2000 and just let it ride. Well, if you invested $1,000 and reinvested all those dividends, this website shows what your annual return would have been, which is about 7.72, which is still, that's a solid return for a company that has a very moderate beta. I think their beta is only 0.6. Yeah, it looks like they only have a beta of 0.66. So very, very moderate beta, low volatility compared to the market, and still having some solid performance over those last 22 years. So I'd say it'd be a good investment for somebody who's thinking long term that just doesn't want as much volatility in their portfolio, or a good way to balance out their very volatile stocks with something else that's a bit more moderate. But now, decreasing revenue and increasing your dividends every single year can't continue. It just can't continue forever, let's say. A company will go out of business if that's the case. So eventually, Coca-Cola is going to have to increase their revenue at some point in time. And through doing some research, it looks like they're actually capitalizing on some new opportunities to bring in a new product line. CNBC just released January 6th that Coca-Cola and Constellation brands are teaming up to create an alcoholic Fresca cocktail. All right, Fresca. So that's massive. That is massive. Constellation Brands is a huge company in the adult beverage space, and Coca-Cola, as you know, international company, has a lot of supply chains and efficiencies that they're running. So to have these two massive giants come together in a deal, I'm really excited to have them come out with a new product. At this point in time, I feel like it's just the thing that the company needs in order to start increasing their revenues. We're talking about the adult beverage space. This is a $1.4 trillion market. $1.4 trillion market. And we have two international companies partnering up in order to break into this area a little bit more. I think there's going to be some pretty cool synergies. There are a couple risks that I would just keep an eye out for, especially somebody who's looking for like massive returns. This might not be the best primary stock to go after if you're looking for just high growth, but somebody looking for more stability and stable returns. This could be an appropriate stock. But the thing that I always look at is what the current price is and how far away they are from their 52-week high and their 52-week low. They're 2% off of their 52-week high, so they're floating pretty close to their all-time highs at this point in time, and 20% off of their 52-week low. So we definitely would have missed some buying opportunities in the past year if you want to see some pretty stable growth within that time. So I'd be a little bit leery personally about entering into into it right at this point. I might look for another pullback, just a little bit of a pullback before entering in, if I'm trying to be more opportunistic or take advantage of some trading opportunities. But if I'm a longer term investor, then I would have no problem entering into Coca-Cola. They are a company that I feel is very stable. Their financials are really strong. Again, we're just looking for their revenue to increase, and it seems like they have some substantial opportunities in the adult beverage market. The other slight risk I look at is their multiples, and they have a multiple of 30. That I want you guys to be aware of is their multiple, their price to earnings multiple. Right now it's at 30, which is still higher than the average. Taking a look at JP Morgan's Guide to the Markets, the S&P 500 index forward multiple, theirs usually sits around 16 to 17. So, right now, a lot of securities are trading well above their 25-year average. The 25-year average should be between 16 and 17 where it floats, and Coca-Cola's right now is at 30. So still a company where their multiples are quite high, and that could correct at some point or revert back to their mean. Really, in fact, most of the valuation metrics that you're going to be looking at for Coca-Cola are going to be overvalued. So, and this is typical valuation metrics when we're looking at price to earnings, enterprise value over EBITDA, over EBIT, price to cash flow. All of them are pretty high right now compared to their sector median. So that's something definitely to be aware of. They're also, I'd say most of them are pretty close to what their 5-year average is for the company. So I'm not overly concerned, but it's something to watch out for and be aware of. But it all depends on how you're valuing a company, right? Are you valuing them just on their multiples, or are you valuing them based on their cash flows that they generate? So there's multiple ways of valuing a company. If you're going to do the traditional valuation metrics just by multiples, doesn't look that attractive. When you look at the amount of cash flow and their other margins, though, as we've seen before, clearly they're doing a great job. And other analysts and authors from Seeking Alpha and their quant analysis do have buy recommendations on this stock. So all in all, it's a great company. As everybody should know, Coca-Cola is a fantastic company. It's all about the questioning, is this the best company for you to invest in? I believe that this is a great place for me to park money long term. If I'm thinking long term, I'm buying and holding this company. Clearly, they're profitable. They're increasing their profits. They're increasing their dividends every single year, at least for the last 59 years. They've paid a dividend for over 100 years. That's so rare to see. And now there's some new opportunities for them to branch into a couple of other product lines. So I think that's pretty interesting. I think there could be a couple little pops in there. Dad joke, but again, there could be some risks. This might not be the stock for you if you're looking for higher growth opportunities. You're really trying to get some massive gains, shorter period of time. Then you might want to look for some other smaller cap stocks instead. This is a mega cap company. They're huge. They are massive. All right, they've got more money sitting in cash than most other companies have in revenue. So that's a really big deal. So this is one of those companies where I feel comfortable parking cash at a safer spot when there's more volatility in the markets. Same thing with Warren Buffett. You see him, he's buying into this company. It's his 4th largest holding in Berkshire Hathaway, B shares. So smart people like that are investing in a company like this as well. Clearly, there's something there. Thank you guys for watching this episode of The Market Interest. Don't forget to like, share, and subscribe, and join us on Facebook at The Market Interest to join in the conversations and share any other topics or stocks that you'd like us to review in the near future. All right, look forward to seeing you guys soon.